Hi everyone, and welcome back to the Independent Dollar as we continue in our February tax tips and updates series. If this is your first time with us, we break down personal finance topics every week in a way that is straightforward and easy to understand. Today's video is going to be a general overview of the income tax system in Canada. If you've ever wanted to learn more about how your salary and investment income is taxed and how the marginal tax rate system works, then this video is for you. I'm also going to share with you some myths regarding taxes on dividends versus capital gains, and a mysterious tax that you have to pay in Ontario as a high income earner that you probably aren't aware of. Canada's tax system is based on a rising scale, meaning the more money that you make, the more taxes that you'll pay on each dollar that you earn. As your income rises, you will also face additional provincial and federal clawbacks of income-tested benefits, such as the GST credit, OAS, and family benefits like the Canada Child Benefit. For individuals living in Ontario earning more than $75,000, you may not be aware of this, but there's actually an additional tax that you need to pay on top of the standard provincial and federal amounts. This additional tax is one of the contributors to a higher marginal tax rate, and I'll get into that a little later in this video. Let's first start off by reviewing the individual income tax brackets. You've often heard people mention tax brackets and marginal tax rates, but how do these work and what are the different tax brackets based on how much you make? How is it possible that the highest federal tax bracket is 33% and the highest provincial tax bracket in Ontario is 13%, yet someone could have a marginal tax rate of over 50%? To answer these questions, we first need to understand how the tax brackets work in Canada. When we're looking at the different tax levels, there are two factors that come into play: federal taxes and provincial taxes. For the 2020 tax year, here are the federal and provincial tax brackets. One common misconception is that you're part of only one tax bracket. So as an example, if you made $60,000 in Ontario, then you would fall into the $44,000 to $89,000 tax bracket and would therefore pay 9.15% in provincial taxes and 20.5% in federal taxes. However, this is not the case. The tax brackets are applied at each level of income. And to understand this a little better, I'm going to show you how this works on a salaried income as well as investment income. Let's meet Bob. He makes $60,000 a year in salaried income. His taxes would be calculated as follows. In federal taxes, he would pay 15% on the first $48,535 and 20.5% on the next $11,465. Provincially, it would be 5.05% on the first $44,740 and 9.15% on the next $15,260. Now, keep in mind that there are additional federal and provincial tax credits that you may qualify for, reducing your total taxes payable. However, to keep things simple for today, this gives you a general understanding of what the tax brackets are and how they work. So in this case for Bob, he will owe $13,286 in taxes. If you're familiar with RSPs, then you would know that making a deposit will lower your taxable income. In this example, an $11,465 deposit would effectively eliminate any federal taxes owing on income earned above $48,535, essentially removing you from the next tax bracket. However, RSPs don't always make sense even at the $60,000 income range. If you haven't checked it out already, we have a great video on when RSPs do and don't make sense, giving you some really great examples of when RSPs may not be the right fit for you. Now that we have a better idea of what and how these tax brackets work, how do they apply to different types of investment income? Well, that depends. Unlike your salary, different types of investment income are actually treated differently for tax purposes. Salary and interest income are taxed the most, followed by dividends, and then finally capital gains, which are taxed the most efficiently. So let's continue our example with Bob. He still makes $60,000 a year in salary income, but also earned an additional $5,000 in interest income this year. Interest income can be earned in a variety of ways. It can be earned on the balances in your bank account, interest earned on GICs, or on bonds. Interest is taxed in the exact same way that your salary is. Compared to the three types of investment income, interest income is taxed at the highest rate. In our $60,000 example, earning $5,000 in additional interest would then increase your total taxable income to $65,000. You would now be paying $14,768 in combined federal and provincial taxes. So how does $5,000 in interest income compare to $5,000 in capital gains income? Capital gains tax occurs when you sell an investment for more than what you purchased it for. An example of this would be selling stocks, mutual funds, ETFs, and real estate. Assuming you earned $5,000 in capital gains, the taxable amount is now quite different than interest income. On $5,000, Canada Revenue Agency only requires you to pay tax on 50% of it, reducing it to only $2,500 of additional taxable income. So essentially, the other 50% remains tax-free. Therefore, to continue with our $60,000 example, assuming you earned $5,000 in capital gains, your taxes now would be based on a total income of $62,500 and would be as follows. Total taxes payable now are $14,027.50. Earning $5,000 in capital gains versus $5,000 in interest income means less taxes owing by about $741. What about dividend income though? How would that compare to capital gains? Dividends are another form of income that you can earn from owning stocks, mutual funds, or ETFs, for example. Income from dividends represents income earned from a company which they then distribute down to their shareholders. These dividend payments represent income that the corporation has actually already paid taxes on though. So to recognize this, individuals who receive these dividend payments receive credit for the fact that these are after-tax dollars, and that credit is applied directly to your tax return in the form of both federal and provincial tax credits. Now, generally there are two types of dividend income: eligible and ineligible. But to keep things simple for today, we're just going to look at eligible dividend income, which is what you can expect to see from large Canadian corporations like Canadian telecom companies, banks, and utility companies, for example. Let's now assume that Bob received $5,000 in dividend income instead of interest or capital gains. On $5,000, he'll start by grossing up those dividends by 38%, bringing them to $6,900. This grossing up factors in the taxes that were previously paid on the dividends to arrive at a pre-tax amount, or a gross amount. You'll now calculate both your provincial and federal taxes, and you'll notice that your taxable income is now considered to be $66,900, not $65,000. That's because they use the grossed up amount of dividends instead of the amount that you actually received when calculating your taxes owing. On $66,900, your taxes would be as follows. Total taxes payable is now $15,332. But wait just a second, we aren't quite finished yet. We still need to apply both our federal and provincial tax credits. Assuming you live in Ontario, this is what they would look like. As you can see, unlike capital gains where the tax benefit is applied right away by using a lower taxable income, the tax benefits of dividends are applied afterwards by using those provincial and federal credits to lower your total taxes owing. Once Bob applies both his provincial and federal tax credits, his taxes payable are now $13,605. But wait, I said capital gains were taxed more efficiently. So how is it possible then that $5,000 of dividend income is taxed so much less than $5,000 of capital gains? Well, it's because at certain levels of income, those provincial and federal tax credits that you receive can actually be greater than your average tax rate. Even as your income rises, the credits you receive offset your taxes payable more than that 50% benefit you get from capital gains. It isn't until your salary reaches closer to $100,000 that capital gains are taxed more favorably than dividends. This is a common misunderstanding with dividends at lower levels of income. Now we reach the final topic in our video: marginal tax rates and that additional tax that higher income earners pay. So what is a marginal tax rate, and why are the brackets so much different than the provincial and federal figures? Your marginal tax rate refers to the rate of tax that you're going to pay on your next dollar of income earned. Here's an example of what they look like for the 2020 tax year, and I pulled these off of the EY website, which I'll link in the description below. So why is it that if the federal upper tax rate is 33% and the upper provincial rate in Ontario is 13%, that you could have a marginal tax rate over 50%? Well, the short answer is provincial surtaxes, that commonly unknown tax that higher income earners are required to pay. In Ontario, on top of paying your normal taxes to the province, those who earn higher levels of income are also required to pay tax on their taxes. This would be applicable to anyone who has a taxable income in excess of about $75,000. Basically, how the surtax works is that once your income reaches a level that generates provincial taxes that are more than $4,700, you're now charged tax on your Ontario taxes, as much as 56% on your taxes payable. As an example, if you make $100,000 a year, you can expect to pay about $800 in additional taxes. At $150,000, your surtax is about $4,000. The more you make, the higher the surtax. On top of the surtax is a provincial health premium. If you make more than $20,000, you're required to pay a provincial health premium, and the amount that you pay will vary based on how much you make. The more you make, the higher your provincial premium. These, combined with the clawbacks of provincial and federal credits at higher levels of income, mean the more that you make, the higher your marginal tax rate would be. For some individuals, that could mean paying over 50 cents or more on each additional dollar that you earn in income tax. This wraps up our latest video in our February tax tips and updates series. Hopefully you found this video helpful to better understand how income and investments are taxed in Canada, as well as understanding what marginal tax rates are. Thank you so much for watching, and we'll see you back here on Thursday.